What if your money could literally pay you every month without you having to sell a single share? That's the magic of dividend investing. It's one of the simplest ways beginners can build passive income and long-term wealth. But before you jump in, let's break down exactly what dividends are, how they work, and how you can start earning them, even with small capital. Many beginners think the only way to make money in the stock market is to buy low and sell high. This approach, often called trading, can be incredibly stressful and difficult to master. Timing the market perfectly is a challenge even for seasoned professionals. That's where dividend investing offers a powerful alternative. It allows you to earn regular cash flow from your investments without ever having to sell your shares. This means you can build a consistent income stream, providing financial stability and peace of mind. The problem? Few people actually understand how dividends are paid, when they arrive, or what makes a dividend sustainable. Let's start with the fundamental question. What is a dividend? Simply put, a dividend is a portion of a company's profits that it shares with its shareholders. When you own a stock, you own a small piece of that business. If the business is profitable, its board of directors might decide to distribute some of those earnings directly to you, the owner. Think of it like this. If you owned a small bakery and it made a profit, you'd take some of that profit home. Dividends are your cut from owning a piece of a large, successful company. Companies like Coca-Cola, Johnson & Johnson, or Apple have been paying dividends for decades, rewarding loyal investors with steady income. Dividends aren't just random gifts. They are strategic decisions made by financially strong companies. Paying dividends signals to the market that a company is profitable, stable, and confident in its future earnings. It's a way for mature companies to reward their loyal investors. These companies often have consistent cash flows and don't need to reinvest all their profits back into rapid growth. Instead, they choose to share their success with shareholders, making their stock attractive to long-term investors seeking income. This commitment to regular payouts builds trust and demonstrates financial health. Understanding the mechanics of how dividends are paid is crucial for any beginner. There are a few key dates you need to know. Let's break down the process step by step, so you know exactly when and how you'll receive your income. First, a company's board of directors announces a dividend on a specific date, known as the declaration date. This announcement includes the dividend amount per share and the important dates that follow. It's the official start of the dividend payment process. Next comes the ex-dividend date, which is perhaps the most critical date for investors. To receive the upcoming dividend payment, you must own the stock before this date. If you buy the stock on or after the ex-dividend date, you will not be eligible for that particular dividend payment. Following the ex-dividend date is the record date. This is the date on which the company officially checks its records to determine which shareholders are eligible to receive the dividend. If you own the stock before the ex-dividend date, your name will be on this list. Finally, we have the payment date. This is the exciting day when the dividend money is actually deposited into your brokerage account. It's usually a few weeks after the ex-dividend date, and it's when you see your passive income arrive. Let's walk through a practical example to make this crystal clear. Imagine a company declares a dividend of $1 per share. If you own 100 shares of this company, you would receive $100 for that dividend payment. This payment typically occurs every 3 months or quarterly. So if you hold those 100 shares, you could expect to receive $100 every quarter, just for owning the stock. This income arrives directly in your brokerage account, ready for you to use or reinvest. It's a tangible reward for your investment. Companies don't all pay dividends on the same schedule. Most companies pay dividends quarterly, meaning 4 times a year. This is the most common frequency you'll encounter in dividend investing. However, some companies pay semi-annually, twice a year, and a select few even pay monthly. Monthly dividend payers like Realty Income, ticker O, are particularly attractive to investors looking to generate a consistent monthly cash flow. By strategically combining stocks with different payment frequencies, you can design a portfolio that delivers income every single month, all year round. Here's where dividend investing truly becomes a wealth-building powerhouse, especially for beginners. Instead of withdrawing your dividend payments, you can choose to reinvest them. This means using the dividends you receive to buy even more shares of the same stock. When you reinvest, those newly purchased shares then earn their own dividends, which in turn buy even more shares. This creates a powerful snowball effect known as compounding. It's the secret that transforms small, consistent investments into substantial wealth over time. Let's illustrate the power of compounding with a simple example. Imagine you start with $100 invested in dividend stocks each month. If you consistently reinvest every dividend payment, your portfolio grows not just from new contributions, but also from the dividends themselves. Over 10 years, this compound growth can turn your initial investments into thousands, or even tens of thousands, more than if you had simply taken the cash. It's like planting a tree that grows more branches, and each new branch then grows its own fruit, which you can use to plant even more trees. This process works silently in the background, building your wealth without you needing to actively manage it every day. Dividend investing is fundamentally different from short-term trading. While traders chase quick profits by predicting price swings, dividend investors focus on long-term ownership and consistent income. This strategy offers a dual advantage: steady cash flow and potential for stock price appreciation. Even when the market experiences downturns, your dividend income often continues to flow. This provides a crucial psychological and financial buffer during volatile times. As legendary investor Warren Buffett famously said, "Our favorite holding period is forever." This philosophy perfectly encapsulates the dividend investor's mindset, building wealth that pays you back for decades. Picture your future self, years from now. You're not constantly checking stock prices or worrying about market fluctuations. Instead, you're opening your brokerage account to see your dividend income steadily rising, month after month, year after year. This isn't just about money, it's about the peace of mind that comes with financial independence. Dividend investing empowers you to build a future where your money works tirelessly for you. It's a journey towards passive income, allowing you to pursue your passions, spend more time with loved ones, or simply enjoy the freedom that a reliable income stream provides. Each dividend payment is a step closer to that financial freedom. If you've learned something new about the incredible world of dividend investing today, please give this video a like and subscribe to our channel. Your support helps us create more valuable content for beginners like you.